And I think they talked about raising like 15 billion for this, but windfall taxes themselves, to me, they seem a little bit targeted, arbitrary, and in a free market unfair. The politicians' rhetoric is, well, we have an energy crisis, but these oil and gas companies are making record profits. What does it say?
Oil and gas firms will be hit with a 25% windfall tax.
Yeah. But what is like the historical background to windfall taxes? And it, to me, it just seems, is that, I guess, politically popular because it's just targeting a group that is demonized. But what is the impact on the companies themselves? Is it just, okay, we make 25% less profit this year?
Well, so the history of it is generally that whenever the state needs funds, especially more so than other times, they will go after demonized groups
Okay.
to try to get them. The challenge here is that energy companies made very little money the past decade, especially the past 5 years. Let's use North America shale, for example. Most of them were free cash flow negative during that period. They basically were producing, they were investing a lot and not making money for it. Now, we didn't do reverse windfall taxes. We didn't give them money.
Yeah, of course.
But now, due to like this, the opposite happening, they said, okay, we're going to stop doing that. We're going to stop plowing money into unprofitable projects. Or we're going to be more capital disciplined. That's what our shareholders want. And so you get this spike in profitability. But that comes after a long stretch of unusually low profitability. And if you look at, say, stock indices, energy companies have been utterly terrible performers over, say, a 10-year period compared to broad equity indices. And now they're finally getting the spike. And then you come in and say, well, now you're the ones benefiting this. We're gonna take that away
and take your money.
And so in the near term, you say, okay, it makes sense. So you take the chunk of that, you give it to people. The challenge is the downstream effects is, does that affect that company's decision to invest in more energy in your jurisdiction? Do they want to bring more energy to market, or do they want to maybe not put a lot of new capital in that industry because they say, okay, it's kind of like how if there's two developing countries, one of them is known for respecting property rights, and one of them every 10 years has a revolution and they take all the assets.
Okay.
If you're a foreign entity, then you have capital and you have expertise and you want to go, say, develop an oil field, you're going to pick the one that you have a high probability assessment that they're going to respect, that you own the assets and you can profit from them. You're not going to put it in the one where you don't know the future of those assets. And so, for example, if there's like this tendency towards windfall taxes, the risk is that a company might say, well, if this is going to keep happening, maybe we should just not really keep investing in the energy space. Maybe we should go elsewhere. Maybe investors will say, even though a company might want to keep investing in the energy space, that's what they do. Outside investors might say, I'm not going to keep investing there because it's just going to keep getting windfalled. So I'll invest elsewhere. And so some of these things can be potentially short-sighted, where the ultimate goal in the long run, the thing that actually fixes this, is to bring more supply online. And ideally, the cleanest and longest lasting. So, in the near term, you just need more supply. Long term, you want the cleanest, best supply to come online. And of course, there's always efficiencies you can do. You can incentivize people to make their homes more energy efficient. There's ways to reduce kind of arbitrary energy loss.
None of these things we've talked about seem to be solving the problem of the amount of debt in the system. Historically, with the I've watched the Ray Dalio video on the short and long-term debt cycle. Historically, how does the debt get removed from the system in the long-term debt cycle? Is there like debt jubilees? Is there defaults? How does that tend to happen?
So historically, when debt as a share of the economy is this big, it defaults in one way or another.
Right.
It could be outright defaults. And that's common, for example, in a developed country where they owe dollars, they can't print dollars, and they just say we can't pay the debts. So
that's probably what will happen in Sri Lanka.
Yeah.
Okay.
And then in developing countries, it generally happens instead through inflation, where they say
developed
countries.
Yeah, yes. Sorry, I thought you said developed.
Developed countries.
Yeah.
Where they say, okay, we're going to pay the debt. Because it's denominated in a currency we can print, so we're not going to default. But we're just going to print a lot of money, and we're going to pay those debts. So you're going to get every dollar or every euro or every pound you're owed.
Yeah, it's just going to be worth.
It's just going to be worth maybe half as much as it was.
Yeah.
When you bought that security. And so that's I think what we're going to see is that inflation is going to be higher than interest rates on average for a prolonged period of time. Now, you could get a deflationary shock like you had in 2020. You can get these brief moments where that's not true, but I think in general, we've already been in a period where inflation is above interest rates, and I think that's going to continue for quite a while.
And what are you predicting with interest rates? I know that's difficult, but the UK, where, what was it, 9%? It's predicted to go up to 10%. The US is 8.3, I think. Eurozone was 8.1 today, I think. I mean, they're all around about that. Do you think these will settle down at like 5-6%? Do you think we could go up to 12 to 15? I know there's real world figures, but we can only really benchmark what we actually know. Do you think we can stay around 8% and it could be for years? Like,
this partially depends on human decisions, which is what makes it challenging, right?
Okay.
So that giving an answer to that partially depends on what is Putin going to do?
yes.
What's Europe going to do in response to Putin? What's the US going to do? So in general, I think we're, say, in the US, potentially reaching a plateau for a period of time where due to base effects, you can kind of level off a little bit. But I think the underlying problem is still unresolved, that there's just not enough energy and certain commodities available. And Europe's got it the worst, but it's global because commodities are a global market. And so my expectation is that if you look back at the 40s and the 70s, you had very high inflation, but it wasn't a straight line. You had periods of pushback.
Okay.
And so I think right now we're kind of in a period of pushback. And it's challenging to say how successful that's going to be because it partially depends on understanding the breaking point when people riot, understanding, is it going to be any sort of de-escalation in this war or no? So those are variables that can influence it. So in general, I am positioned towards an inflationary outcome without trying to predict exactly what level inflation is going to be, especially because, as you pointed out, there's real numbers. There's different pockets of inflation. So I think that looking back at the end of this decade, energy prices are going to be much higher in dollar, euro, pound, yen terms than they are right now. But I think it's not going to be a straight line.
And I think it was a few shows ago, you said to me, you think the story of the next decade is inflation. So it's clearly not going to be a short-term solution. But I assume at some point when things start to level off, it will become a good time to start investing in certain areas. Like you as an investor, what kind of time horizon, what kind of things are you looking at? It's important to have some dry powder ready.
Yeah, so I'm rather defensive as central banks are trying to push back a little bit. They're trying to suck liquidity out of the market. But I'm still, majority of my assets are in these long-term hard assets, things like energy producers, pipelines, profitable companies producing real things, Bitcoin, some gold, different types of commodity exposures, basically real world exposures, real estate. And so basically my approach is to have this kind of diversified set of real assets, as well as some cash for liquidity to rebalance into any sort of, liquidity shocks we get, things like that, kind of take advantage of that counter-cyclical approach. So when people buy high and sell low, I try to just tweak it a little bit and do the opposite. But I'm not like I'm not actively trading the market too aggressively, just kind of a small dial that I kind of lean in when things get a little cheaper, and I kind of back off a little bit when things get a little bit euphoric.
But those hard assets, property, gold, Bitcoin, but also energy companies, because I think based on everything you said, you're assuming there's going to be some significant investment in energy production somewhere.
We're seeing it to some extent. I mean,
Okay.
we're seeing more interest in the space, but I think a lot of the market is still thinking this is transitory, and they're also concerned about the what percentage of the profits they'll be able to keep and things like that. And so we're not seeing this massive ramp up in capex. We are seeing an interest in capex, and then ironically, some of the supply chain things can feed into that. I mean, some of the materials they need to do energy capex are actually held up from logistics problems, right? So it kind of all ties into each other. But I think that this is a multi-year process to realign supply chains to some extent, as well as bring more and more types of energy to market. I think this is so historically, these commodity cycles are these 5 to 10 year cycles. I mean, they take quite a bit of time and capital to ramp up. And I don't really see this one being any different. And I'm kind of monitoring as we're seeing high energy prices. I'm seeing is tons of more capex flooding into the market? Not really. We're seeing an uptick, but we're at no kind of no way of measuring it. We've seen like a massive glut of oil coming anytime soon.
And what about what's happening with rates? Because I know it's very difficult for the central banks to raise rates at the moment, but at some point, with regards to curbing inflation, that is one of the weapons they have. I think rates went up slightly in the UK again recently. Do you think there's a chance that rates will go up significantly, or do you just think it's just not palatable?
So I think that they're going to try to raise rates until something breaks.
Okay.
Right. So in the 70s, they were able to raise rates because debt as a percentage of GDP was low. So
Okay.
you could put rates into double digits, and that interest expense was still relatively small. I mean, it put the economies into a recession, but it didn't put you into a depression.
Okay.
Whereas in the 40s, when you have sovereign debt's 100% debt to GDP, and it's even worse now because you have all this private debt, if mortgage rates are 10, 50%, if treasury debt is 10, 15%, everybody's insolvent. Everybody's insolvent.
Mm-hmm.
And so I don't think they're going to be able to get to positive real rates, meaning rates that are higher than inflation levels. They're certainly trying to uptick them. But of course, they're doing it rather slowly. I mean, we're sitting here with, as you said, like 8% inflation, and they're like, okay, 50 basis points here, 50 basis points here, which is funny because that's actually the fastest they've done it in 20 years. In the US, we haven't had 50 basis point hikes for like 20 years. But it's also woefully insufficient. And so I think that regardless of what they do with rates, that's not what solves this. What solves this is bringing more energy abundance and commodity abundance to markets. And in the meantime, I think they're going to try to protect their currencies until you sort of get outright recession, or you get credit markets freeze, or you get sovereign bond markets get illiquid and messy, right? So in the United States, that could mean that, whenever you see the dollar gets too strong, foreign sector doesn't buy a lot of treasuries, banks already are stuffed full of treasuries. Who's the marginal buyer of treasuries? So you get less liquidity in the market. It gets messier. And then, as I said, with Europe, I mean, who wants to buy Italian sovereign debt right
Not
now?
me.
Who wants to buy that and hold that for 10 years? And so
Yeah.
who wants to buy Japanese government bonds at 0.25% for 10 years when they have 200% debt to GDP?
I'd rather buy Bitcoin for 10 years.
Yeah.
Okay, amazing. Really, really helpful. What are you optimistic about, Lyn?
Energy investments,
Okay.
Bitcoin, long term, good real estate, healthcare stocks, things like that. I think that there are.
Why? Because you think we're going to get stressed and sick and be eating garbage?
It's just an area that I think is profitable, and that is, unfortunately, it's, they have a lot of ways to get a lot of money.
But is it something that generally tends to be more profitable during economic difficulty? Because I know, for example, during recessions, it's good to invest in Domino's.
Well, it's one of the, so healthcare is one of those like mandatory expenditures where people are not going to cut down on their healthcare as much as they're going to cut down on their retail spending when energy prices get high. So I'm rather defensively positioned. When we look at long term, I'm optimistic on just human ingenuity, right? So I think we're going through a quote unquote fourth turning. So a time period where we're examining our existing institutions. We have decreasing levels of trust in them, whether it's governments, whether it's media, whether it's corporations, whether it's basically the things that have been built over the past 50, 100 years, and wanted to build new institutions. And that transition is always very messy. And sometimes it turns out very poorly. Sometimes you get a worse next state than the prior state. You could have the wrong sorts of ideas of why those institutions went wrong, and then build even worse ones. That's kind of what you had in say some of the prior cycle. That's part of what led to the world wars. On the other hand, you can tear them down and rebuild better institutions. And so my always hope is that we, actually identify the problems and then, get through the difficult period and then build out better institutions going forward and better technologies and better ways of doing things.
Amazing.
Just before we close out, you're expecting the next 10 years to be bullish for commodities, but what about equities?
I think it depends where you look. Like I said, I think that there are equities linked to commodities that are attractive. I think there are areas like in healthcare and things like that that can hold up pretty well. I think that there are regions in, say, Latin America or Southeast Asia where their equities can do pretty well. And then I think, you can eventually have more and more Bitcoin-related equities Right now they're private market, but they could become public. So I think there are certainly pockets of equities that can do pretty well. Generally, during rising commodity environments, a lot of the equities that benefit from disinflation, so a lot of the tech stocks, a lot of the very growth-oriented things, those are the ones that kind of suffer and stagnate. It doesn't mean their underlying assets do poorly. It just means they might have been so overpriced that their stock price can kind of chop along or go down, even as their underlying business does okay. And I think that's kind of the environment we're in, where Adobe is going to keep doing great in terms of, say, selling software, but maybe their high price point got ahead of itself. And that's not even the most extreme example.
And that's again because there's just too much credit in the system.
Well, there's too much credit in the system. And also, when commodity prices are very low, we tend to, and the interest rates are very low, we price equities very high. Because, for example, if my alternative is I can buy a 10-year treasury and get 1% interest rate, I might be willing to accept equity risk if I expect 5% returns on average over the next 10 years, right? I'm getting 4% better than the treasury. But if inflation is high and treasury yields are 3-4%, I might want 8, 9, 10% equity returns. And so I have to pay a lower price on the same equity in order to get those higher forward returns. And so that's generally when you get that kind of more inflationary, higher rate, higher commodity price environment, you get margin pressure on companies, and you also generally get lower valuations on companies. And that's why that transition from higher margin to lower margin and higher valuation to lower valuation can mean, stagnant, choppy, sideways stock market, sometimes down, sometimes up, but not very much, even as the underlying products and services are, of course, still growing and useful.